Hello, everyone, and welcome back to my channel. Today, we're diving into the latest economic events from the United States. We'll cover the most significant news in macroeconomics, market movements, and key financial indicators, and how all of these affect your investments. If you're into U.S. stock market investments, or just following the latest economic trends, you're in the right place. Let's start by talking about the big events that shook the U.S. this past week. Throughout this week, we've seen both political and economic developments that are impacting the market. The first and perhaps most significant event was the rise in domestic protests, something that could influence the political and economic climate for months to come. These protests were sparked by frustrations over President Donald Trump's latest political moves. The protests reached over 1,400 cities across all 50 states. They mainly focused on issues like healthcare, tax reforms, and the government's stance on climate change. The largest protest occurred in Washington, with an estimated 20,000 people participating. These protests have led to a dip in public support for President Trump, which has in turn fueled political uncertainty. As a result, market volatility has increased. Investors are concerned about the political instability that might arise from these protests and the uncertain outlook for policy changes moving forward. Next up, let's talk about trade tensions. On April 2nd, President Trump made headlines again by announcing new tariffs. The U.S. imposed a 10% tariff on all imports, with some countries, including the European Union, facing up to 20%. This move is part of the ongoing trade war strategy to reduce the U.S. trade deficit and bring manufacturing jobs back to America. Now, while this might seem like an attempt to bolster the economy in the short term, many analysts believe it could have negative long-term consequences. Import prices could rise, affecting consumer goods and potentially increasing inflation. Additionally, businesses that rely on imports might face higher costs. In fact, we've already seen some signs of this happening in industries like electronics and automotive. But here's the kicker: China didn't take this lying down. On April 10th, in retaliation, China imposed tariffs of 34% on all U.S. goods. This escalation has resulted in another significant dip in stock market indices. The U.S. and China, two of the world's largest economies, are locked in this tit-for-tat war, and the markets are reacting. Shifting gears a bit, let's now look at some key economic and macroeconomic events that unfolded last week. One of the most significant indicators is unemployment. On April 11th, we saw the latest jobless claims report, and it's good news for the economy. Unemployment numbers are still low, which shows a relatively strong labor market. However, it's important to note that the growth in jobs has slowed, and there are concerns that wage growth is not keeping pace with inflation. While there are plenty of job openings, some analysts are questioning whether this low unemployment rate is sustainable in the long term. Another major factor that investors are keeping a close eye on is oil prices. As of April 11th, the price of West Texas Intermediate (WTI) crude oil was trading at $85.4 per barrel, a slight increase of 0.2% for the week. Similarly, Brent crude rose 0.4%, reaching $89.79 per barrel. So why does this matter? Well, higher oil prices have a direct impact on inflation. Gasoline and transportation costs rise, which can lead to higher prices across the economy. This in turn puts pressure on consumers, and central banks like the Federal Reserve have to consider these factors when making monetary policy decisions. Speaking of inflation, another critical piece of the economic puzzle is the Consumer Price Index, CPI. The March CPI data, which will be released on April 12th, is highly anticipated because it gives us a glimpse of the inflation trend. As of now, inflation in the U.S. remains persistent, but it's showing signs of slowing down, which could give the Federal Reserve some room to cut interest rates. Now, the Federal Reserve's key interest rate has also been a major point of focus. The current federal funds rate is 5.0%, which is the highest it's been in over a decade. However, the market is speculating that the Fed might consider lowering rates soon if inflation continues to ease. The next few months will be crucial. If inflation doesn't drop quickly enough, the Fed may hold off on lowering rates, and this could lead to further volatility in the markets. Lastly, let's touch on consumer confidence. As of April 11th, the U.S. Consumer Confidence Index has been relatively stable, though slightly down from last month. Consumers are cautious, given the uncertainty around inflation and the political climate. This cautious sentiment is reflected in stock market movements, where investors are more risk-averse right now. So, what's the bottom line? This week has been full of significant developments that will affect investors in the U.S. and globally. Political protests and tariff wars have led to increased volatility, while key economic indicators like unemployment, oil prices, and inflation are making waves. The Fed's upcoming decisions will be crucial in determining whether the market stays in its current limbo or if we see a shift. As always, stay informed and keep a close eye on the markets. If you're investing in U.S. stocks, make sure you're prepared for some potential volatility in the near term. Thanks for watching, and don't forget to like, subscribe, and hit the bell icon so you never miss an update.